Welcome to this explainer. If you're gearing up for your auditing exams, you might be falling into the trap of thinking an auditor is basically just a glorified number cruncher. But we're going to completely flip that mindset today. A truly great auditor, they're actually a financial detective. And today, you're getting the ultimate detective training. We're going to completely decode ICAI standards on auditing 520 and 550. And honestly, by the end of this explainer, you'll have such a rock-solid comprehensive grasp on these concepts that you literally won't even need to reopen your textbook for exam revision. Let's get into it. Okay, here's our case file for today. First, the Auditor's Toolkit. Second, SA 520 Analytical Procedures. Third, Investigating Number Anomalies. Fourth, SA 550 Related Parties. Fifth, spotting relationship red flags. And finally, number 6, your final exam revision. Starting with Section 1, the Auditor's Toolkit. To solve any case, a detective needs the right tools. And our very first tool is all about finding patterns in the data. Let's look at the official ICAI definition for SA 520, which is Analytical Procedures. At its absolute core, this standard is really just asking, do the numbers tell a consistent, logical story? You're evaluating financial information by studying plausible relationships. And a huge point to remember here, this doesn't just mean money. It includes financial and non-financial data. For instance, think about a factory. If their electricity consumption, which is non-financial data, spikes by 20%, well, their production output and their corresponding sales, the financial data, should logically show a similar upward trend. If they don't, that's an unusual fluctuation, and you've got to investigate it. Let's do a quick active recall prompt right out of your study material. Imagine you're auditing a client and their sales went up by 50% this year. Awesome news, right? But then you take a peek at their debtors and those have absolutely shot up by 150%. What in the world is going on here? This is a massively inconsistent relationship. Are they booking fake credit sales just to inflate their revenue? Are their collection policies completely falling apart? That huge gap is your trigger to start digging. Moving to Section 2, SA 520, Analytical Procedures. Let's see exactly how the standard tells us to handle that 150% anomaly. For the exam, you absolutely have to know when to use analytical procedures versus a test of details. It's a classic comparison. Analytical procedures are your big picture overall analysis. Because you're zooming out to look at trends and ratios, it's way faster, it costs less, and it's perfect for predictable balances. Think payroll, where you have fixed monthly salaries based on set contracts. On the flip side, tests of details are the nitty-gritty. It's individual checking, literally verifying specific invoices one by one. It's time-consuming and expensive, but absolutely crucial for unusual or high-risk transactions. As the auditor, you're always balancing the two for efficiency and accuracy. And that brings us to one of the most common analytical procedures, trend and ratio analysis. If a company's gross profit ratio suddenly plunges from 30% last year down to just 18% this year, your alarm bells should be ringing loudly. You can't just write down that it dropped and move on. You must investigate. Could there be theft of inventory? Did they mess up the valuation of closing stock? Or have they been doing heavy, undocumented discounting just to push sales out the door? The numbers are literally pointing you to where to look. Section 3. Investigating Number Anomalies. Knowing the steps to take when expectation doesn't match reality is a make or break skill. So here is your core SA 520 methodology, step by step. Step 1, you collect the data. Step 2, you develop an independent expectation. So for example, you estimate the interest expense yourself by just multiplying the loan amount by the fixed interest rate. Step 3, you compare your expected number against the actual recorded number. Step 4, if there's a material difference, you put on your detective hat and investigate by questioning management and getting evidence. And finally, Step 5, you conclude whether or not the balance is reliable. Keep this framework in mind for the exam. Analytical procedures aren't just something you do once and forget about. You use them across 3 totally distinct stages of the audit. Stage 1 is risk assessment, right at the very beginning to understand the business and spot risk areas. Stage 2 is substantive analytical procedures, during the middle of the audit, where you're actually using them as audit evidence to verify balances. And Stage 3 is the overall review right near the end, just to make sure the final financial statements make sense and line up with everything you've learned. Now, this brings us to a huge pivot in our explainer. We've spent time talking about catching unusual numbers, but what if the numbers look absolutely pristine on paper? The math adds up flawlessly, but what if the actual relationships behind those perfect numbers are completely compromised? That leads us into Section 4, SA 550, Related Parties. This is where the audit detective shifts focus from following the math to following the motives. Enter SA 550. A related party is any person or entity that has control, significant influence, like say owning 20% of the voting power, or a close relationship with the company you're auditing. This means your holding companies, your key management personnel, your directors, but it also includes their relatives. Imagine a setup where a company director's wife is somehow the main supplier of raw materials, or the company just hands a massive interest-free loan to its managing director. These are textbook related party transactions, and they require incredibly strict disclosure in the financial statements so the investors know exactly what's happening behind the scenes. Section 5, Spotting Relationship Red Flags. Why do we care so much about finding these parties? Because they might not trade at normal market prices, and that can easily be exploited to manipulate profits, hide liabilities, or even conceal outright fraud. Let's quickly rattle off the major red flags from the source material you need to watch for. If you're auditing and you spot massive transactions happening right at year end, or perfectly round numbers, because let's be real, actual business rarely deals in perfect zeros, your fraud radar should be screaming. Why is the company handing out interest-free loans? Why is there zero documentation for a huge service fee? Why are there these insanely complex group structures with shell companies or transactions that just don't have a clear business purpose? These are massive, flashing warning signs that a related party transaction is hiding something sinister. The ultimate benchmark you are looking for here is called an arm's length transaction. This basically means the deal was conducted as if the two parties were total strangers, acting independently, and bargaining at fair market rates. So if the company sells goods to a director's private firm, you have to ask yourself, would the company offer this exact same price and these exact same credit terms to a complete stranger? If the answer is no, then it is absolutely not an arm's length transaction. So what's your plan of attack? Following the SA 550 flowchart, you start by explicitly asking management to identify all related parties and transactions. But you don't just take their word for it, right? You're a detective. You inspect the board minutes, you review shareholder registers, you look at complex contracts to truly understand the relationships. Then you assess the fraud risk, get your evidence, and crucially, you check that every single material transaction is properly disclosed in the financials. Section 6, Final Exam Revision. We've gathered all our clues, we know our numbers, we know our people. Let's organize this case file so you are 100% prepped for exam day. Take a mental snapshot of this slide, as it's your ultimate quick revision checklist for SA 550, directly recreating the table from your ICAI material. Your objective, audit relationships and transactions. The risk, fraud and manipulation. Examples, holding companies and key management personnel. Your procedures are inquiry and inspection. Red flags are things like interest-free loans. If you stumble on undisclosed transactions, you investigate and evaluate the fraud implications. And your final check is always adequate disclosure. If management refuses to disclose, you might just have to modify your audit opinion. And for SA 520, to make sure you maximize your marks, you've got to sprinkle these exact exam keywords throughout your answers. Please don't just write compare numbers. Write trend analysis and ratio analysis. Talk about the reasonableness test. Mention how reliability depends on the predictability of the balance, like fixed interest rates being super predictable, and the precision of your expectation, meaning how tightly you can actually estimate the figure. Using this specific terminology proves to the examiner that you didn't just memorize, you actually understand the standard. I want to leave you with this final, somewhat provocative thought to ponder about the limits of an auditor's responsibility. If management actively colludes to hide a complex related party transaction using fake paperwork and shadow companies, are you, the auditor, fully responsible for uncovering what was explicitly designed to be invisible? It's a really tough question. But armed with the tools from SA 520 and SA 550, you are equipped to be the best financial detective possible. Thanks for joining this explainer, and happy studying!